Hey guys, what's going on? Welcome into the video. So we had a very eventful week in the stock market. In this video, we're going to talk all about it and what to expect next, including some important mistakes to avoid, and then go over 5 stocks that I'm watching for the month of February of 2024. As always, there are timestamps in the description, and let's go ahead and get into it. So starting out by taking a look at the S&P futures chart. Last week, we went over these key levels at 49.34, 48.98, 48.73, and then the key zone at 48.30 to 48.41, which was that breakout point out of the previous 1 month consolidation. And we talked about as long as above there, buyers have full control of the trend. And what played out is we had a very volatile week filled with catalysts. At FOMC on Wednesday, the market had a pretty big sell, with the S&P making it down to 48.73. And now that is a spot where buyers came in, which is the bottom of this current range, and then it rallied from there into Friday to make new highs. So into next week, it's important to continue to keep things simple. The key pivot that I'll be watching to start the week is at 49.57, and as long as it's above there, Friday's breakout is intact, and this is set up to continue higher. If it fails back below 49.57, which was Friday's breakout, that breakout would fail and it can send the market back into the chop range between 49.57 to 48.73. So for upside, it would need to reclaim back above 49.57 from there, or if it makes it back down to the bottom of the range at 48.73 and that level was to break, it would lead to a test of that major 48.30 to 48.41 zone, which would be a major decision point for the market. So there were a ton of traders getting very bearish this past week because of FOMC and the jobs report. And those traders that were betting on downside got absolutely killed on Thursday and Friday. It was overall just a simple technical move that pulled back to test the bottom of the current trading range at 48.73, which obviously held strong, and then it made it back to highs of the range and broke out from there. So do not try to be a macro economist and think that you're smarter than the market. Just keep things simple and follow price. When the market is ready for a sustained pullback, technicals will show that. Until then, we can ride the upside trend, and there is no reason to be bearish yet. Last week, we also had a ton of earnings reports that were market movers. Some reported blowout numbers such as Meta and Amazon, and some reported duds such as AMD and Apple. AMD's earnings were a slight beat, but they also lowered their top line guidance for next quarter. As a stock that had rallied 90% plus in the previous 3 months, you would expect that the stock drops big off of those earnings and lowered guidance, but all that it saw was about a 4% dip that got bought up pretty quickly off 164.46, which was highest from 2021, and is now on the verge of a potential breakout higher if it breaks above that 177.5 to 179 zone. And the same type of thing happened with Apple. Earnings for this quarter were mostly in line with expectations, but they had a sizable miss on revenue guidance as they now expect $90 billion in revenue next quarter versus the previous estimate of $96 billion. After all of that happened for the stock, it gapped down to the key 180 level, which held as strong support once again and made it back up to the 186.5 to 187 pivot zone. These dips got bought up immediately. If that tells you what kind of market that we're in. As a trader, you really have 2 choices. Say that the market is wrong, be stubborn and short it, or have the mindset that the market is never wrong and just trade price. Stubborn traders will lose money, and flexible traders with an open mind will make money. Now, I think we can all agree that the market is not fully efficient, and there are mispriced stocks all over the place, some expensive and some cheap. But the only thing that will pay you is price, and the easiest thing to do and what will make you money is to follow price and not fight the trend. And don't get me wrong, there could be a bear case for a stock such as Apple if it tops in this 186.5 to 187 pivot zone, which could form a head and shoulders pattern where below 180 after that would be the breakdown trigger. But until something like that confirms and the indexes support it with a sustained pullback, there is just not a reason to be bearish or trying to call a top on stocks right now. But now getting some trade setups that I'm watching in the week ahead. Starting out with the couple that I went over last week, Snowflake, ticker SNOW, is one that we went over as it's been on the verge of a breakout out of this multi-year consolidation pattern. Out of long-term well-defined breakouts like this, it is not uncommon to see a couple fakeouts before the real breakout move happens, which is what played out, and we potentially got what that real breakout move is on Friday. From here, I'll be watching the previous highs at 211.65 to hold as new support if that is tested, and no lower than 205.6, which is the breakout trigger and top of the long-term range. As long as it holds above those levels, this breakout is intact and has potential for a large move higher, with those next targets above at 224.1, 232, and 269.6. Another stock that we went over last week was Applovin, ticker symbol APP. This stock has been basing tightly below the $45 key resistance for over 6 months and now on the verge of a breakout. This is another one that had that fake out move and now potentially setting up for that real breakout if it is able to hold above 45 as new support from here. The initial targets above are at 50 and 60 to 62.6 above. And arguably the best looking breakout setup as we head into next week is Mongo DB, ticker symbol MDB. So this stock had a huge earnings gap up in June of last year, and since then has been consolidating for over 7 months. And it has been building out this large cup and handle pattern, and along with this, it has also formed an inverse head and shoulders pattern within that handle. So 439.2 is the key level to watch, where a break and hold above there can start the breakout out of this large base. Above there, the upside targets that I'd be watching for would be at 460, 515.5, 526.85 gap fill, and then 570 to 590. And another one that I'm watching as a potential recovery play is Google stock, ticker symbol GOOG. So this is one that had disappointing earnings last week and actually followed through to the downside, making it down to a little bit below 140 per share before putting in a hammer candle on Friday. This looks very similar to last earnings that it had in October, where it had that large gap down before making a full recovery in the weeks following, and I marked those with arrows as you can see. If the broad market is able to stay bullish, this could easily play out once again here, and I'd be watching for it to hold above 140 as support on any dips from here to keep that possible bounce back in play. So that is what I'm watching for in the week ahead. Do not try to be a macroeconomist. Do not try to call the top on stocks. When it happens, technicals will show that. Until then, it is much easier to make money by following the trend and price. And thank you guys for watching. For anybody interested in joining the private Discord chat, that is the first link down in the description to get my personal trade alerts, nightly watch lists, and I answer any questions you have in there. And I will catch you all next time. Good luck trading this week, and peace out.